You may have heard that ETFs are more tax efficient than mutual funds, and that is true. You'll pay less money in taxes with the same strategy in an ETF than you would a mutual fund. Let me show you a great example. We'll start with the Invesco equally weighted S&P 500 mutual fund. This makes a good example because there's also an Invesco equal weighted S&P 500 ETF, and the equal weighted S&P 500 strategy by Invesco rebalances quarterly. So quarterly, it is selling some of its holdings and thus realizing capital gains. When we look at the tax cost ratio, we can see on the mutual fund over 5 years, it has a tax cost ratio of 1.54%. That means that each year to pay taxes, you would have to pay on average 1.54% of your portfolio value. Now let's look at the ETF tax cost ratio. Here it is, the equal weight ETF RSP, S&P 500 equal weight. We can see the tax cost ratio over the same period at 5 years is 0.73%. It is less than half of the tax cost ratio than the mutual fund. So you're saving about 50% in taxes simply by investing in this strategy's ETF than you would its mutual fund. Now you might ask, why does it work like that? Well, at a very simple level, ETFs are able to exchange their holdings with an intermediary, whereas mutual funds have to sell and buy their holdings, thus realizing capital gains that they have to distribute. So the bottom line is, any strategy is going to be more tax efficient in an ETF wrapper than it is a mutual fund, particularly active strategies. That's a wrap on this one, guys. I hope I kept it short. I'm signing off.